Hello, everyone. Welcome to Multifamily Naked Truth, episode 10. I have a very special guest today, Mr. James Knull. He's actually broadcasting from Vancouver, British Columbia, although he's from Edmonton originally. So you might have seen James as part of Mogul Realty. He's a very strong conduit between, Vancouver investors and in Edmonton, Alberta. He was a member of the real estate investment network, RAIN. That's where I actually met James, probably, 10 or 11, maybe even 12 years ago, James. But
Yeah.
welcome to the show. We're really happy to have you on today.
Yeah, Cory, it's an absolute pleasure to be chatting on the show. And you know what? Lucky number 10. That's a good number. So I'm excited to rein your awesome podcast into the double digits.
Yeah, I have to start by, saying, you and I we're kind of blessed and cursed at the same time with German heritage. So our last names are spelled exactly how they sound, right? So, most people would call you Null instead of Canal. That's how it's pronounced.
Yep, that's right.
Same thing with me. It's Spurl. Everybody says Spurl. It's like, no, the E is not silent. It's Spurly. So I had a
Spurly.
little chuckle about that. Yeah.
Oh my gosh. Yeah, I've been saying Spurl the whole time. If I had known it was German. Yeah, we say every single letter in that language. So yeah, there's no silent letters. Okay, Spurly. Now I know. Canal and Spurly. Those are a little German lesson for everybody tuning in.
Cool. So a little bit of background on James. We'll get into a little bit more, but he's a really strong expert in infill and suited houses. That's how I really got to know James back in the day in Edmonton. But most people probably don't know. James is also really big into multifamily. He's bought several buildings over the last decade, and like James, we've had we've had incredible highs, and we've had some really downturns and struggles that we've had to adapt and pivot in the last decade, which is what I want to kind of talk about today. But first off, James, why don't you tell us a little bit about yourself? I mean, when you got into real estate, and your involvement with the RAIN network.
Yeah, absolutely. So you know what? I got into real estate basically right out of university. I went to high school, straight to university. I didn't take a gap year or anything. So 22 years old, just graduating from uni. And, I was in a fraternity in university. So I was pretty used to like co-living situations, living in the frat house. And I was talking to my dad and he was like, "Hey, are you sticking around Edmonton?" And I said, I guess so. Yeah. And he said, "Well, why don't you just buy a house and rent all the rooms out to your buddies? Like, you know, the gig." And he's like, "You might as well have them paying you rent instead of you paying somebody else rent." And I thought, yeah, sure. That sounds like a good idea. So found a house with 5 bedrooms, bought it up. I mean, back then houses in Edmonton were so cheap that, my 5% down payment was like $10,000. So,
Yeah.
like whatever. That was not unreasonable to scrounge together. Sure enough, lived in one of the bedrooms, rented out the other 4 to my buddies, and it went great. Like we just had a blast, and you know what? Like the value of the house went up. I was building my equity. The mortgage was getting paid down. All the good stuff that's supposed to happen was happening. So I bought another house just up the street and moved 5 more buddies into that house, and we terrorized the block for a couple of years. But that's what really got me into real estate was just being like, okay, I mean, I think I can do this. So I started talking with other people who own real estate, started going to real estate networking events. RAIN, Real Estate Investment Network, was a big part of that. And just was flipping a few houses, buying a few houses, and that was really the start of it all. I loved it so much I decided to be a realtor. Everybody was asking me, "Hey, can you help me buy a house?" And I said, "Well, that's not what I do." So I thought maybe this is what I should do. And from those humble beginnings, every year I picked up a few more properties. Every year my real estate practice got a little bit deeper. And, fast forward to today, 15 years later, I've got a portfolio of about 250 odd units. And I've got a real estate team with 25 agents in 2 provinces. And in terms of the RAIN network, I mean, that was an integral part of me learning what real estate was all about. I mean, when I started in real estate, I thought, well, how the heck do you buy real estate if you don't have any money? Because I was just a dumb kid. I didn't have any money. I barely scraped together $10,000 for a down payment. And I remember learning about the concept of joint ventures at RAIN, and I thought to myself, I think I can do that. And so I just started talking to every single person who would give me the time of day about real estate and saying, "Would you do a deal with me? Would you be a joint venture partner with me?" And it was probably about a year of people just telling me to buzz off because I was a noisy 22-year-old. But eventually my pitch got good enough that somebody was willing to say yes, and that was my first joint venture, and that kind of kicked it all off.
It's hilarious when you say that your age, because I know when you started, there was probably a lot of age discrimination. I mean, you didn't have the beard back when you
I
started.
couldn't
And I
grow a beard.
remember, yeah, I mean, your first deal, I wouldn't even call it a house hack. I mean, we didn't have terms like house hack and BRRRR back when I started.
Yeah,
There's pretty much rain was the only game in town as far as education.
that's
You know,
right.
I bought a single family home and I rented the basement. Now, I mean, you went one step further. You were already living in that environment, with buddies. And I do know people that have done that well, but I mean, that has to be for the right person. I mean, you wouldn't attempt that if you've never cohabitated with another person before. That would be a disaster.
Totally,
Um,
yeah. Like, I mean, I'm definitely built for it. Like the fraternity house had 20 odd guys living in it. I mean, it was my idea of a good time. It never sucked. It was always awesome. Like there
you
was,
could have had a reality TV series before
yeah.
reality really became famous. So what year did you get started? Was that around 2008? I can't remember
Uh,
exactly what year you got
that
started.
the unofficial frat house and then the unofficial frat house up the street were bought in 2005 and then 2006. That was the start of it. So I mean, yeah, you're right. Like we bought those houses before, or I bought those houses before Facebook was even invented. So there was no such thing as reality. I had a flip phone for goodness sakes. Like that was the times. Um, and then 2007 is when some some mentor or something of mine said, hey, you should come to this rain thing, and I went to the rain weekend mega conference, which was called Quick Start at the time, and they rebranded it to Acres at some
Yeah,
point.
Acre, yeah.
Yeah, and that just blew my mind. I was like, holy smokes, people are doing this like as a business. Okay, I can do this, I think. And I just went for it.
Yeah, and I remember reading some magazines. I mean, you reach celebrity status pretty quick with Rain. And back in the day, I mean, if you missed the Acres, I was a member of Rain. You couldn't watch it on the internet. They sent you CDs. So you
Yeah.
got these CD packs, right?
Yep.
And that was kind of where I first heard your name. It was like, okay, there's this guy, this James Knull. He's talking about, he's the suited house guy, if you want to add a basement suite. And then you talked about how to do that. And that was shortly after you'd become a real estate agent. But on one of those episodes, you talked about multifamily. And you said, well, I bought an apartment building and now, I'm looking at buying another one. And I'm thinking to myself, wow, I mean, this guy's getting into multifamily now. Around what time was that? What year was that? And what made you decide to branch off into multifamily?
That would have been, I remember it distinctly because I wanted to get into multifamily, but I had no idea what I was doing. I had basically just figured out how to buy houses with basement suites, like you said. And, but at Rain, like so Rain kind of gamified real estate. If you remember, you got your pins, you got your bronze pin,
Yeah.
your silver pin, your gold pin, your diamond pin, or whatever. And, the level up, and so I mean, I bought into that mindset big time when I was that age. I mean, I was like, okay, let's win, let's level up. And so the next level up was to buy multifamily buildings. And there were, these speakers on stage who talked about like, Rain really built a culture around once you perfect multifamily, you're ready to level up, or single family, you level up to multifamily. So I knew that, I was like, okay, I think I can level it up. So I started, just kept talking to people about multifamily, learning about it. Rain had a multifamily kind of power weekend at the time where they taught the multifamily fundamentals. So I went to that. I think um, and then I ended up meeting a guy who was about my age, a commercial mortgage broker, who also wanted to get into buying multifamily. And so he was really strong on like the deal architecture, financing, deal analysis kind of end of things. And I was a lot stronger on the in the trenches, like property management, how to raise capital. Those were kind of my areas of expertise. So we partnered up, and I mean the timing was terrible because went on a 3-month backpacking trip through Southeast Asia, about as stereotypical as you can get in your late 20s, and kind of forgot about it, and then got back, and I mean, within a week of me being back, this guy called me and he was like, "Hey, are you back from Asia yet?" And I'm like, "Yeah," and he's like, "One of my clients has a 12-unit building they want to sell. Do you think we should do it?" And I'm like, "Sure." So one thing led to another. We analyzed it. We needed to raise $250,000, and I just ripped around like a Tasmanian devil, asking everybody I could for capital for this deal, and that was the start of it all.
Nice. Yeah, and I remember like so in Rain there was a few experts there, and I remember the first multifamily weekend because it was well known that Don Campbell also invested in multifamily, but it
Yeah,
wasn't something that was really openly talked about in Rain. So I followed Thomas Byer. I originally invested in one of his deals. That's kind of how I got into multifamily. I actually had him as a guest. I think he was episode 2 of this, of my
amazing.
Naked Truth of Multifamily, which it's a keep your clothes on show, folks. It's don't get fooled by the title, even though he's a strapping young lad. But no, there was all Arlen Dolan, there was Don Campbell and
Hmm.
Thomas Byer, but no one was really into multifamily. So, I mean, at the time there was a portion on my rain space where you could pitch your deals. You know, that was the website that
Hmm.
pretty much everybody was on. There was no social media, there was nothing for Facebook, not really any mechanisms for raising capital. I mean, now it's gone overboard. Now you look, it's kind of everywhere you see, and not necessarily legal or ethical. Things were very different back then raising capital.
Yeah, I mean, yeah, yeah, it's such a noisy space with social media. I mean, everybody can create their own spotlight, but I remember back in the like early days, Don would say, he's like, "Hey, you know what? If you have a spotlight, take it." And I mean, back then, everything Don said, I was like, "Okay, whatever he says, I got to do because this guy's a genius."
Yeah.
So, he'd talk about guys who, would like get custom like shirts made saying like, "Talk to me about this marketplace," or "I invest here," or, just like in a place where you can't create a spotlight in social media, you had to create a spotlight in physical space. And I remember quite specifically, there was one event where he said, "All the realtors in the room stand up." And he said, "Okay, this is your time to shine. Tell me what you specialize in." And like some realtors were like, "Oh, but I sell houses." And then
Yeah.
some realtors were just really confident, like, bam, 30 seconds, sounds super pro, super concise, super smart. And sure enough, people would flock to those realtors at the networking breaks. And so the way that, I mean, it sounds ridiculous now that I think about it, but what I did back, like we're talking like 2008, 2009, is I got an old, like this was when the Edmonton Oilers had those dark blue jerseys. So I grabbed one of the old school jerseys that were bright orange. And then I was with Remax at the time, so I got a little Remax balloon crest, and I put a Remax balloon crest here, and then one on each shoulder as the shoulder piece. And then on the back, I got custom letters that said, "Talk to me about Edmonton cash flow." And then I just stood up everywhere wearing this jersey, making as much noise as I could. And sure enough, like people that wanted to talk about cash flow in Edmonton would come talk to me. And that's how we started building the bridge out to Vancouver. Is, Don said there's a lot of people in BC that want to invest in Alberta. And I said, okay,
Yeah.
well, I flew out to the acres in Vancouver and, spun around in my jersey trying to be as visible as possible. And that really got things moving for me, because it made anybody that wanted to know anything about Edmonton, they were like, "Well, I don't know, the guy in the Edmonton jersey, I guess, is from Edmonton." And that was those were the kind of things you did back then, because there was no other way to create attention other than just being bright and loud.
Yeah, I don't know if that approach would work in Vancouver with a Canucks jersey this year. They haven't been doing so they haven't been
Yeah,
doing so well, but
they
no,
haven't had the best
I love
season.
that approach. But so I want to ask you about the deals and analysis. But before that, I'm just going to kind of fast forward to today. I understand. I'm not going to ask you how many doors you have. Well, you already said the amount of doors, 200 and some.
Yeah.
But I believe it's like 13, lucky 13 apartment buildings that you're managing now. Is that
Yeah.
correct?
Yeah, we've got 13 multis, and then the rest are a hodgepodge of different types of single family units. So, um, like right now, I mean, I just did an acquisition, and then I'm selling off a few houses in Edmonton. It's I look at my portfolio like a garden. Sometimes you got to pick a few weeds to make some room to plant some new ones, So I'm picking a few weeds right now, getting rid of some properties that are underperforming. But yeah, in terms of the multi space, there's 13 apartment buildings in there.
Yeah, I love your garden analogy, and that's very very well to know because a lot of people, they'll hang on to properties that maybe they shouldn't. You got to keep your portfolio moving. But like onto the multis here. So first few deals, when you were first getting your feet wet, I mean, we get the realtor pro formas, right? We look at this. Okay, well, this is fairly simple. We just have to go off the numbers and make an offer. Tell me about how you selected your first deals and the due diligence process. Like, did you have 10 buildings to choose from and you whittle it down to two? How did that process kind of work at the beginning?
Yeah, I mean, the way that I did it at first is probably not the way that like you'd recommend. Like the idea is look at a bunch of buildings, analyze a bunch, make the best choice. But the first building that we looked at made sense to us. And so, luckily my partner was really strong in the analysis space. Like I knew how to run a pro forma on a single family using the rain cash flow analyzer, like that was my move. And I had my spreadsheet that auto calculated a bunch of the stuff, so that was all good. But multifamily is a different gig because the different numbers go into the equation. You want to calculate your cap rate, net operating income. It's not the same as the cash flow analysis. But I didn't quite understand that. The other thing that I didn't understand at first is the discrepancy between what's advertised in the pro forma, how the building's actually performing, and what the potential performance of the building could be. Those are kind of three different
Yeah.
spaces that all play into the analysis.
Yeah.
So, our analysis was based on the actual performance of the building compared to what we think we could bring the building to with some better property management and better and with some renovations. So
The upside, essentially, what you're down.
exactly,
Yeah.
exactly. So that first deal was a big upside deal. Like we planned out a massive, massive, like top to bottom, all suite, inside and out building renovation. Very, very large, very complicated. Um, Doing all the things. And I mean, the thing is, like now that all that's done, that building was basically like new. So it's been nice in the portfolio ever since because it's been very low maintenance. Um,
That would be classified as a BRRRR then. And to take on a BRRRR like that, a full renovation for your first project is pretty impressive. And not many people can pull that off.
I mean, I don't even know if we fully pulled it off. Like we had enough gumption that we didn't even know any better. But I'm like, yeah, I mean, I bought houses and renovated them. This is just a big house. How hard could it be? Like that was
Right.
that was like literally the mindset is I've done something smaller, so let's just do it in a bigger scale. And I mean, it worked. It worked out well. Like there are obviously things that didn't go perfectly, but as a whole, we were able to, we got the rents to where we wanted to. The expenses were where they needed to be, and we were able to refinance and move a bit of the capital out that we had invested, which was nice. But yeah, I mean, the thing that really kind of got me is just we bought that building direct from the vendor. The second building we bought is where I really got that experience of, here's the pro forma from the realtor. And we're
Yeah.
like, okay, well, these numbers look great. Let's put an offer based on those numbers. And then all of a sudden we get financials from the seller. We get the rent
Yeah.
roll. We get the leases. We walk around the building and interview some of the tenants. And it's like, wait a second, this building is nothing like what the seller is or what the selling realtor is projecting it to be.
Yeah,
Which
and also when you try to apply for financing, you realize that they're only lending you there's a debt ceiling on the net operating income. So maybe you didn't quite get the loan that you were anticipating either. I
yeah,
know that happens to a lot of people.
yeah, exactly. I mean, the building, most lenders are going to lend more so on, like, some of them will lend a bit on the potential, but more so they lean towards what the actuals are.
Yeah.
So, so that was a bit of a learning curve to start developing an intuition for what the advertised is versus the gap. Because in single family, it's more or less what you see is what you get. Like it's taxes, you can't fudge the taxes. Utilities, what utilities on a building like that are going to be. Building condition, it's one house, it's one building. You tour it before you put in the offer. Whereas in multifamily, you don't really get a full tour until after you put in the offer. So the amount of pre-offer information you get on single family is enough to make an offer that's almost completely reflective of the value of the building, less like a sketchy furnace or a leaky toilet or a couple of like minor renegotiations. But the pre-offer and post-offer information in multifamily can swing the value of the building by hundreds and hundreds of thousands of dollars, which is crazy. So it's
Yeah.
it's kind of weird to have to put in an offer and put out a huge deposit when you're given such an insufficient amount of information to properly value the building. But as far as I can tell, that's just part of the gig. So that's how you
Yeah,
do
that's
it.
something I've gotten used to. And, I've been in that position too, where I've had buildings under contract and had to go back. I have my method really fine-tuned now, James, where I'll make an offer based on my best estimation of the current rent roll, what the market rents are. So I'll call my property manager and say, okay, what are the actual market rents? So what can I actually get the rents to? And take a best guess on a loan opinion from a couple of mortgage brokers on what a loan looks like before I make the offer.
Yeah.
And then if I do get the offer accepted, I'll go and walk through within 7 days. So then, if I'm ever going to ask for a haircut or a retrade, they call it,
Yeah.
I'm doing it right away. I'm not dragging this out 2 months, to piss off the seller and come at the very last second and ask for a reduction. I'll know my price within a week of going in, you know, and doing it, trying to hit that accurate value as close as you can. But like you say, with limited information, that's extremely tough, right?
Yeah.
And you want to be in a good position with the seller that if it doesn't work out, that you don't want to insult them, so that, if they eventually want to come back to you, that they will. So
Yeah.
I found that really touching. It took me many years to kind of figure that out.
Yeah, it's well, there's like a spectrum. There's the value of the building based on the actual current performance right now. And the holy
Yeah.
grail for any multifamily investor is to buy it bang on the money for the actual performance right now. But most people that are selling a building are selling a building that is not performing optimally. Otherwise, they wouldn't sell
Yes.
it. So then there's
Bingo.
the, yeah, so like that's this end of the spectrum. On that end of the spectrum, you have what the building should be operating if it's being optimally performing, right? Market rents, clean as a whistle, a bunch of good tenants, and like expenses that are not out of control. And then the actual sale price is often somewhere in the middle. And then that's where the power of the negotiation comes in, and the market demand and how many other buyers are in play. The more in demand the building is, the closer it's going to sell to the potential. The more the less in demand the building is, the closer it's going to sell to the actual, which is totally different than residential single family. Because if you're buying, like if we translate that back to single family, if there's a crappy, sketchy house that needs to be renovated, well, you're not going to sell the house for more than its actual value because there's potential to renovate it and make it nicer. You don't buy potential in single family, but in multifamily and commercial, you buy potential all the time. And there's a gap there between what it's actually worth according to the lender and what you pay for it. And often that gap needs to be filled with like mezzanine debt or additional equity or something like that.
Yeah, and we really saw that, James, in like 2007, right, when the condo conversion craze hit, and then again when the energy boom in 2012 to 14, where
Yeah.
people were buying more and more on potential. They weren't looking at the rents today. They were looking at the trajectory of Edmonton rents,
Yeah.
and broadcasting down the line and say, well, okay, if I can buy this at 120 a door today, it's going to be worth 140 a door tomorrow, which is, as far as I know, that's how people in Vancouver and in Ontario buy apartments.
Yeah.
They're not buying it on cap rate or cash flow. They're buying it for the momentum and what they can get it for,
Yeah.
next year, kind of thing.
Totally. And so, yeah, if you're pretty darn sure it'll be worth 140 and it's worth 120 right now, well, if you buy it for 125, you still have 15 on the table per door. And that's how a lot of that's what happens in markets that are increasing, is that speculative buying.
Yeah. So I take it then you had quite a few deals you maybe had under contract. You probably didn't close on all of them. Was there cases where due diligence items came up and you said to your partners, this just isn't going to work, and you ended up walking away?
Totally. Yeah. I mean, we probably chowed through somewhere from between like 75 and 100 grand worth of due diligence on buildings we didn't buy. Um, be it, building condition assessments or, appraisals, environmentals, et cetera, et cetera. Travel to and from the location of the building. Like those, the time it takes you to actually check out a building, it's an intangible because you don't put a dollar value on your time. But every time you spend a week deep diving into a building, that's a week you didn't spend deep diving into a different building. So that opportunity cost has a value that's difficult to quantify, but is important to keep in mind when you think about where to invest your time and effort.
Yeah, so yeah, and nowadays, so now after you've done this process several times over, you've probably got a system fine-tuned where now you know exactly what you're looking at. I don't know when the last time you bought a building was, but now there's certain maybe locations or certain, types of building that you're not going to waste your time on anymore. You're very much more focused in what you're looking for.
Yeah, yeah. Well, when like it's just like anything. When you're new, you have more time for more leads that are lukewarm. And then the more
Yeah.
experience you get and the more precious your time gets, the more discerning your top of funnel filter gets, because you just say no to more stuff more quickly. But like when I was new at it, I was like, anybody who said they had a multifamily deal, I was in there analyzing until 2 in the morning because I was super excited to see if it would work. And now it's like you look at a building and you're like, okay, I my initial criteria are 10 check marks. This has 9. No, I know that one check mark is going to make me say no to this in a week, so I might as well save myself the headache.
And I love the way you just phrased that. That's amazing. I'm gonna steal that soundbite. I want to ask you about, so on the pro forma, I want to ask you specifically about deferred maintenance, and it's a big gotcha. I mean, even I know Terry Peranich in Edmonton, and he's invested like twice as long as I have, and he's been caught with this. We all buy this building. The roof is 8 years old. We're thinking, oh well, I'm never going to have to replace this. I'm going to pass this problem off to the next, person, or the parking lot, or the decks, right? Or, a number of deferred maintenance issues. And these are not on the pro forma generally. So if you're looking at just your income, your expenses, right, which is like your utilities, your taxes, your R&M, but the R&M does not include these major deferred maintenance items. Can you
Yeah.
speak on deferred maintenance a little bit and how it's affected your portfolio?
Oh man. Yeah. I mean, I'd go as far as to say this is a topic I'm passionate about because it's so important. And you have to develop language to articulate this in a negotiation. So I feel like this is going to turn into a longer chat because it's so important. So let's get
It's all
into it.
good. Let's do it.
For everybody listening in, I would say this is one of the most critically important concepts to like get comfortable and skilled in when acquiring multifamily. That's my opinion. So let's get into it. So first is deferred maintenance, which is stuff that'll come up down the road. So like you said, the roof, for example.
Yep.
There's big ticket items, roofs, boilers, windows, decking for
Windows.
balconies, hallways. Like there's just there. And so when you buy a condo or a strata, there's a condo fee. They save a reserve fund. That reserve fund builds up to pay for these things down the road. In real estate investing terms, you put in 5%, 8%, 6% repairs and maintenance. But repair and maintenance usually gets eaten up with the definition of repairing and maintaining the building, which is, quite literally, painting this, fixing a drippy tap here, like just breaking stuff or fixing stuff that's broken. Capital
Even
items,
on a brand new building, you're going to have some R&M,
of
whatever it
course.
is, $1,000 per unit per year, or whatever, on any building.
Yeah, 100%. And that's not the same as those capital expenditures. So
Yes.
you don't want to pro forma the capital expenditures because it drops your net operating income, which drops the value of your building. So what I've started doing is I create like the front facing pro forma, which is the NOI that helps you determine the building value for refinance or sale. And then there's like this second level, which is like the back office pro forma, which is okay. Once the front facing pro forma is done, then what do we continue to take off of that price point to manage and maintain the building? So like I actually have like a second level of savings for repairs and maintenance that doesn't make it onto the pro forma because you don't want to hurt the NOI too much. But the actual reality of running one of these buildings, if you intend to own it long term, is you have to save additional money, just like a condo, just like a strata, to have money set aside for larger capital expenditures. And then you kind of make a decision. If you end up selling the building before that capital expenditure comes up, well, you've got cash in the bank. Great. That's part of your exit. You've got cash to share with your joint venture partners. But if you own the building long enough, at least now you've got cash set aside to deal with those items. So from a joint venture management perspective, and even buildings that I own completely by myself, I don't take all the cash flow because you kind of are robbing Peter to save Paul. Like if you take all your cash flow out and distribute it to yourself and the partners, if a capital expenditure comes up that wasn't budgeted for, there's no money for it. You're all putting the money back in anyways. So I leave
That's a huge rookie mistake, and a lot of people have been nailed with that, including myself. Like I'll keep a reserve fund of 5% of the purchase price, which might be 120 grand on a 24 suiter, but that's really not enough, man. That doesn't even cover the cost of one major deferred maintenance item, and you don't want to be having these discussions with your joint venture partners with a cash call saying, "Man, okay, I knew this roof might have had needed replacement. Guess what? Now it does. I need 30 grand from you."
Yeah.
Right?
Yeah, it's a bummer to have that conversation. So,
Yeah.
it's it from a pitching your joint venture partner perspective, like, it's a delicate balance of being as optimistic as possible to get them excited about investing in the building, but then simultaneously saying, hey, you know what? Like, yes, this building could be cash flowing. I'll make up a number, $5,000 a month, but I think we should distribute 25 of that cash flow and then save the other 25 as a second reserve, just in case, just in case. This will form part of your ROI if we exit without a capital expenditure. But and then I almost put it back on them being my joint venture partner by saying something like, would you rather have a cash call if something comes up that's big that we didn't expect? Or would you rather just have more cash flow on an ongoing basis and then manage that cash flow on your own in case we need to re-inject it into the building? And I found most partners are like, let's just save it in the building. I don't want to have money come to me and then leave me again. So, and then if we have it at exit, we can split it. So that's kind of how I've handled it. And, but I mean, at the beginning, we're all enthusiastic, aggressive, and wanting to put a deal together. And then that wisdom comes with time of like, they're like, oh, if I make my pro forma more conservative, my ROI goes from 18% down to 13%. But
Yeah.
but I found most investors are happy with a more safe 13% because it still beats the crap out of mostly anything they can invest in or whatever.
Well, yeah, and competence will attract capital. And now that we've been at this a while, you have a track record and we see this happening. Like one of the things that I cringe at is when I see these investment pro formas that say, the cash on cash is going to be 8.85%. It's going to be exactly this. Well, you have no idea what it is, especially if you're buying a 40-year-old building. Chances are your cash flow is going to get burned up. And I basically stopped paying my investors out altogether. I used to pay out monthly payments, and
Yeah.
now I'm doing very much like you're doing. We're building up a healthy reserve fund, and I really love the way you worded that, like almost like a strata. You almost have a reserve fund, and I think that's a conversation that an investor can get behind because they understand that concept, right?
Yeah.
It's not like we're going to put the skinniest amount of cash in this building. We're going to try to buy it with an extremely high seller financing, maybe 10% down, and then spend no money, right? And then just sell this thing for massive profits down the road. It generally doesn't work like that.
Yeah.
I mean, we've all had the home run or two, but you can't rely on those deals.
No, no. If you build every investment around a best case scenario, like best case scenario by definition is like a 1 in 10 scenario. So if you build 100% of your strategy on a 10% outlier, you're going to get screwed really hard 90% of the time.
So just on deferred maintenance, then what are some of the like? I don't know if you have maybe some ballpark costs. I mean, I guess it depends on the size of your building, but I mean,
Yeah.
a roof. I did a roof that was $120,000 in Beaumont. But what are
Wow.
some of the other items like windows?
Yeah.
Maybe you can.
I mean, boiler will cost you 25 to 40 grand. Windows have gotten a little more expensive because of the supply. I mean, everything has gotten more expensive because of supply chain, but I mean, windows can be anywhere from 500 to $1,000 per window. Sliding doors will be anywhere from 1,500 to 2,000 per sliding door. So these are things that add up. Um, I mean, I don't want to speak out of turn and start quoting numbers
Yeah.
on here. Let's see, it's March 3rd, 2023. So if you're watching this a year from now, the prices will be different. But I mean, I let me zoom out and make a more general comment. If you're going to get into the multifamily game, talk to your contractors because I'm assuming you at least have some real estate experience if you're going multi. Very few people start with multi. So talk to the contractors you already know and trust and start getting ideas of what all these things are going to cost because as the investor, you need to be accountable for your own information. Just like don't trust the rent that's on the pro forma, do a rental survey. Or one of my favorite hacks is I just put up ghost ads. Like I'll literally take a unit in the building, grab the pictures from the listing, put it on Kijiji using the address, like using a made up address on the same street and see how many hits I get at each price point to confirm the rents. So there's a little James Knull secret for you right there.
That's a
Um,
great way to do your own rental survey. I mean, I used to silent shop for Thomas where I'd go to his buildings and judge the customer service. But ads and that, like my property management managers will do that for me. But yeah, I mean, you got to be up to speed on everything because it's a change. Like let's just talk about expenses. Like my property manager, Brayton in Edmonton, we used to use like 3,000 per unit per year. Then it was
yeah.
4,000. Like now he's using 6,500 a unit per year because utilities in Alberta have almost doubled because of
Oh,
carbon taxes and administration. And as multifamily owners, we're eating those costs.
100%. Yeah,
So
it's an all-inclusive rent. So, the rental market, the elasticity of the rental market compared to the expenses, like rents haven't climbed as fast as expenses over the last 5 years. So multifamily has gotten a bit tighter. I want to go back to the deferred maintenance question for a
yeah,
second
sure.
because there's another concept that I think is super critical in that conversation, and it's something I've coined the term maintenance deficit, and it's basically issues in a building that cost money to repair that don't present themselves because of strong rents. So let me talk about the
Mm,
scenario that I think every single person here needs to be super aware of when they're paying attention to a building, which is a maintenance deficit. So we know that the value of the building is tied to the net operating income, which is tied to the rent that you're collecting in the building. So the type of building that really scares me is one that has strong rental numbers because of a collection of long-term tenants, but then when you walk into their suite, it's an absolute disaster. That's what I
yeah.
call a maintenance deficit because what that'll show up in the building valuation as rent. Okay, Scruffy Joe over here is paying $1,000 a month, and he's been paying $1,000 a month for 7 years. So what's the problem here? He's a reliable tenant. but you walk into that suite and you see a white bathtub that's now kind of yellow. You see a kitchen where the melamine is so scratched up and like, there's just layers and layers and layers of caked on dirt. The flooring, you can't see the flooring, but you're pretty sure it's not looking so nice under there. And so when I look at a suite like that, I think, okay, right now, this Scruffy Joe suite is maintaining building value because it's offering $1,000 a month of consistent rent to the net operating income. But in reality, if anything happens and this guy leaves, I have probably got 2 to 3 months of vacancy to pay for, in addition to a $10,000 to $15,000 full suite renovation. Now that's an extreme case, but there's smaller examples of that where, as you're going suite by suite, I look at I always ask myself, what would I need to do to this suite right now to re-rent it? Because even if a tenant like Scruffy Joe has been there 7 years, there's no guarantee he's going to be there 8 years. And so I create a ledger of everything I would need to do to every suite to re-rent it, because that is what I'm calling my maintenance deficit. That is all money that will have to get spent if for whatever reason any tenant leaves, in order to get the same rent that it's currently being rented at. Because if Scruffy Joe leaves, I can't rent that filthy, disgusting, broken down suite for $1,000 a month until I spend 15 to 20 to get it there. So like this $1,000 a month of rent has a hidden cost of $20,000 associated with it.
I love the way you mentioned that with deferred maintenance and that analogy, because I mean, this is something that people don't take into account. And I remember in Edmonton, and when rents were rising really fast, 2007, you could turn over a unit. Scruffy Joe could leave and you could pile in the next warm body for more rent because we had 0% vacancy. But now in Edmonton, in a healthy market, that suite's not renting. Like you could discount that thing $300. No one's going to move in there. So
No.
you have to account for those costs. Like, so James, how do you do that? Do you build that kind of hidden maintenance cost into your purchase price? Or how do
Well, this
you
is yeah, and this is going to circle back to your ability to articulate this to a seller, because the seller is going to say, "Hey, I've got this much net operating income, and these tenants are stable. They've been here forever." And so
yeah.
you have to be able to come to the plate and say, like, I don't think that these tenants are going to be around too much longer, and when they leave, all this money is going to be spent. So like that's the kind of thing that happens with sellers that know they're going to sell, is they kind of pull the plug on maintaining the building, and they just
Yeah.
do what they can to pump up the rents to have a high net operating income to attract an inexperienced buyer to the building, who you buy it, and then all of a sudden 3 or 4 tenants leave and you have a $70,000 bill you didn't expect, just to
Well, what
get.
else they do too is they'll put in tenants that have maybe poor credit that can't rent anywhere else, so they'll have to pay higher rents just to get in that building. There's all kinds of tricks, right?
Exactly. So that kind of segues into a due diligence conversation where, when you get a building inspection done in multifamily, you get what's called a building condition assessment, which is not the same as a residential inspection. A building condition assessment, they look at all the major structural components of the building, the roof, the windows, the boiler, whatever. Whereas in residential, you get a full breakdown of, like, the home inspector will plug his little thingy into every single plug-in and use his moisture meter around every bathtub and whatever. Like, residential inspection is super thorough and gives you a very accurate assessment of the condition of that building. You don't get a suite by suite breakdown. So the onus to do that is on you as the purchaser. And that's where you're going to uncover this maintenance deficit, because on paper, you might have, it's like 12 suites of people all paying $1,000 a month. And then in reality, you've got 3 nice tenants, 3 okay tenants, and 6 suites that are just total trash, with people that are, have all kinds of different issues. Maybe they're smokers, maybe there's, evidence of drug use, maybe there's just, hoarders. Like, no offense to these kind of people, but these are like, those activities are what create maintenance deficits of tens of thousands of dollars in a building. And so, like, that has been a reason I've walked from buildings, is when I do a suite by suite walkthrough, I'm like, look, if these 6 terrible tenants leave, I have $100,000 bill. Like, we're going to have to talk about that as part of the purchase price. And a lot of sellers will know that that's going on, and they'll be like, you know what? I'm just going to wait for the next buyer who might not be as savvy as you. And so,
Yeah,
like,
because the next buyer could go to the bank. The bank's not really going to look at that as closely as you are,
no,
right? So they're going to
no,
lend strictly on net operating income. They're going to say, okay, this thing cash flow is fine. You take it over a month later, now you have all these vacancies and you're stuck with these problems.
100%. Yeah. So that's super duper critical. And it's mind blowing how expensive what feels like a small problem. Like, another part of due diligence that I strongly recommend is get a bed bug inspection done for the whole
Oh
building.
man.
Like bed bugs are one of the most, like, bed bugs and cockroaches. Wow, those are hard and expensive to get rid of. And they can often seem like a game of whack-a-mole, because you'll treat one suite and the two neighboring suites have them, and then you'll treat these two and it's back in this suite. And I mean, the pest control company, they don't provide guarantees and warranties on their work. They're like, we showed up and provided a service, and if the bugs come back, it's because the tenants, they put it back on the building.
I
So
just walked on a building like 100 units in Saskatoon because they were consistently spending $35,000 a year on pest control for cockroaches, and they just could not get rid of the problem.
yeah,
And the guy's trying to sell the building, and I'm looking at this. The two things I look for is on the expenses when I get the op statements is I look at pest control, and then I look at like windows and door damage, like break-ins. Right, those are the two things I look at. But nowadays, it's more pest control is something that really has to be taken seriously because it's
yeah,
like
it's just,
nasty.
yeah, I mean, like, beyond the ick factor of like ew bugs, it's just like, like, if a suite needs to be painted, once the paint's on the wall, the problem's solved. But with pests, or I mean, quite literally, it's an organic problem, and so it can just like ebb and flow around the building. And like I said, you just feel like a dog chasing your tail sometimes, trying to, like, the source, this, like, treating the root of the problem. The root of the problem can move around the building, and so you can't identify a root problem and fix it, because I'm not even articulating myself well, because I've clearly dealt with a lot of frustrations around pest control issues in my buildings over the
Yeah, and
years.
then
But
certain areas of the city too. Like if you're investing in like Queen Mary Park in Edmonton is a prime example. I mean, some of those buildings in that area just seem to be plagued with that. But I'm just gonna segue onto the maintenance deficit again. I'm just gonna give you my own example
yeah,
of what happened in a changing market. I mean, I bought in Saskatoon. I bought a 24 suiter, great building, but about half the suites needed a bunch of work, but they were renting for high rents. I mean, it was late 2014. The economies of Saskatchewan and Alberta were screaming along. Very low vacancy, very high rents, and I thought I can just keep going with this. I'm not going to have to replace these tenants. And then bang, right? The oil slump happened. And, Saskatoon went to 20% vacancy. They had built a bunch of new builds. So I basically lost all my tenants to the new builds because they dropped their rent by like 50% and they had in-suite laundry, they had underground parking. So, I had units that were renting for 1250. I suddenly had to renovate them, re-rent them for 1,000. And then I'd have those guys leave and I'd have to re-renovate again. And I've rented for like 900. And that went on for like 3 years,
yeah,
completely drained my capital. But the good news is now that building is completely renovated and now we're back in an upswing of rents. But man, that was a hard lesson. And I was a veteran at the time. I thought I would knew this, but I was, pretty arrogant at the time. I've gotten a lot smarter now. But I want to hear, James, about your experience, in 2000, 15-ish to I guess 2021, the really slow periods. I mean, how did you retain your tenants? How did you survive those times? Giving rent incentives, having to lower your rent. What was that experience like?
yeah. I mean, the very similar experience to you. It got expensive because, I mean, when we ran like optimistic, pessimistic, worst case scenario, and when the oil slump hit in like 14, 15, 16, what actually happened was worse than our projected worst case scenario. And so when things get worse than your worst case scenario, you're like, huh, it's like when you say, well, what happens if you get hit by a bus? Like, nobody actually gets hit by a bus. Well, actually, if you pull the statistics, about once a day somewhere in Canada, somebody dies by getting hit by a bus. Like, it's rare, but it happens. So like, we were
Yeah.
in our hit by a bus scenario, and like, the big players, Boardwalk and Main Street, basically as soon as that market hit, they had deep pockets, and they were like, okay, no damage deposit and 3 free months of rent. Well, that's hard to compete with. 3 free
No
months of
kidding.
rent. Like, wait a minute. So no damage deposit super jacks up the risk of this tenant, and 3 free months of rent. That's a $3,000 to $5,000 incentive per unit. Wow.
Yeah.
Times that out by a 20-unit building or 200-unit portfolio. Like, the amount of lost revenue gets expensive fast when you're competing with that type of incentive program from some of the competitors in the marketplace. So, I mean, there isn't a pretty answer to that. Like, the pretty answer is that we, one of the things we were very intentional about was raising capital from medium to high net worth individuals. Because, you know, just a word of wisdom about raising capital, if you raise $50,000 from somebody who only has $50,000, and that is the most important thing in their life, and they're like signing over their net worth to you, that's super risky, because there is
Yeah.
no buffer or tolerance for risk in that situation. Risk being, what if things go worse than the worst case scenario? So between my business partners and myself, we're all blessed with having pretty steady incomes and strong positions. And, you know, we just had to like feed the buildings for a little while. And, you know, we're like, okay, let's keep these buildings going. Let's do the renovations. Let's offer the rental incentives. So there were some cash calls involved. But I mean, even though they're tough conversations to have, the numbers are the numbers and the news is the news. And when we're sitting down having shareholders meetings saying like, the market is literally worse than the worst case scenario that we all signed off on. Like, if any of you had thought it would have gotten this bad, you would have never invested in the first place. So like, this sucks, but we're in the storm together. So like, let's make some decisions and keep these buildings alive. And so, very similar to your story, that there's a lot of great quality renovations and the buildings are in great shape. And now we're slingshotting around to the other side, and people want to live in our buildings because the demand is coming back. So, you know, it's a strong lesson in doing the things that you need to do to make sure you weather the storm. So, you know, I heard you say like we had a big cash reserve to weather the storm. Great. Part of our weathering the storm was working with a bunch of high net worth, high earning individuals where, okay, you know, instead of them not being able to put food on the table, well, they all cut a couple of luxury vacations out of their game plan, and you know, maybe saved a little bit less into their stock portfolio for a few years. But, you know, like, it sucked. It wasn't a happy feeling, but it was okay. As opposed to, you know, selecting partners where they're already on the edge and one worst case scenario is going to collapse the whole deck of cards.
Yeah, that would have put you in a forced selling position. And I know a lot of people that levered high in 2012 to 14 and then had to refinance in 2019. You know, they were underwater. Their rents were low. You know, a lot of them people lost their buildings. Some people had to
Yeah.
pay, a lot of people had to pay down equity. You know, I know friends personally that had to, they weren't, you know, you're not going to get this big BRRRR refinance. You're not even going to renew. The bank actually wants 300 grand from you to keep
Yeah.
this building. And I know
Yeah.
people that's happened to now. People listening in Ontario or listening to this conversation probably, you know, maybe somewhat horrified to learn that this can actually happen. But I can tell you, folks, I mean, James and I have been through this for the last 8 years, and it can happen. And, you know, people from Ontario will say, well, I mean, Alberta's risky. You hear this a lot, right? It's boom and bust. I mean, you gotta be ready for that ride. And I guess I somewhat agree with that, but I more disagree because, you know, I think it's a stable market. I've been investing on the prairies forever. I grew up in Saskatchewan, but our price points are nowhere near where they are in Ontario and BC, right? You know, I've investor buddies in Toronto. They're like, well, I just paid 400,000 a door, but I'm never going to have a problem finding tenants. I'm never going to be able to, you know, I'm never going to, you know, be in the situation that you're in. And I'm thinking to myself, well, I mean, how do you know that with any certainty, right?
Yeah.
Like, I feel more comfortable now having lived through what I just lived through, buying a new building than I would be, you know, buying something in Ontario, to be honest.
Yeah. I mean, you know, it's the risk of BC and Ontario is like, the prices keep going up, and then that creates confirmation bias that because the prices are high and because the
Confirmation
prices
bias.
keep
Yeah.
going up, it's like, well, they always go up. But like, will they? Like, when will that stop? Or, you know, it's just like saying like things are always going to be slow in Alberta, but based on all of the macroeconomics, people are coming and they're coming in hot, and like Alberta's going to go through another cycle. So, you know, I mean, it's kind of one of those things where you paying 400 a door makes a lot of sense as long as it goes to 500 a door. But will it? Because what happens if it goes to 350 a door? You're already negatively cash flowing. Like, you're literally investing against good business fundamentals of cash flow, rolling the dice that there's appreciation coming, which
Well,
is,
especially if you've done a BRRRR, right? You've taken on short-term interim financing at really high rates, and you're hoping to refinance with CMHC on the MLI Select program, for example. I know a
yeah,
lot of people that are in that position, and that's not a guarantee by any stretch.
100%.
But let's talk about the good news. Let's talk about Alberta. You know, 60,000 plus people have moved to Calgary this past summer. You know, it's hot and heavy. You know, from Alberta, sorry, from Ontario and BC, ton of people flooding in. I think we're on the cusp of a boom. I mean, if we look at the 90s, most people that I talk to, it feels like now we're kind of at the long we're at the final end of a 10-year cycle. We tend to go in 10-year cycles, right? We
Yeah.
had the 80s, the 90s, the 2000s, and now it feels like we're at the long end of this. You know, honestly, rents right now in Edmonton are still like lower than anywhere else in the country. I mean, the average rent now is $2,000 for a one bedroom pretty much everywhere, except
Yeah.
for Alberta and Saskatchewan. So I
I
think we
know.
got a lot of upside ahead. What are your thoughts on the market, James, in the next, 12 to 18 months for rents?
Yeah. I don't even need to say anything too complicated. I mean, we're cheaper than everywhere else in the country, both on the purchase price and the rent side. There's elasticity there. Like one of two things need to happen to fill the gap. The rest of the country needs to come down or Alberta needs to catch up. And based on the fact that
Yeah.
500,000 people are coming to Canada next year, simple supply and demand of housing, like, well, there's more people that need to live somewhere. So I don't think the rest of the country is going to come down. I think Alberta is just poised to catch up. And that's point number one, is just like the gap is the gap has to be like closed up a little bit. So that's number one. And then number two, like housing demand is what dictates housing price. And the more people there are wanting to live in a place, the more demand there is. So, 60,000 people moving to Calgary, that's a lot of people for a small city. That's a huge,
Yeah.
huge addition. And like Edmonton's in the same boat, like there's tens of thousands of people flooding into the Edmonton region as well. So, when Trudeau announced the plan to have 500,000 new Canadians, a huge chunk of those are marked for Alberta, especially
And
considering
yeah,
Alberta is such an
absolutely.
affordable place to
Absolutely.
live.
They're natural entrepreneurs, and that's where they want to go with the low taxes. And I think those those numbers coming into the prairies are only going to accelerate. I mean, even like Saskatchewan from Ukraine, they have a big Ukrainian population, a lot of a lot of people coming in. I mean,
Yeah.
we saw it in the Calgary rents already, right? Like the rents have already gone up like 30% in a year, but it hasn't quite hit Red Deer in Edmonton yet. And back in Rain, they always told us there was always this bit of a lag, right, between Calgary and Edmonton.
Yeah.
But it feels like that wave is coming to Edmonton.
Yeah.
Do you agree?
I mean, just even at the ground level, I can see it, like
Right.
anecdotally, we've just done a rental analysis for all of our suites, and like we're in the situation where like $100 a month increase across the portfolio is not out of line. That's kind of what we're seeing. I've got our property managers tuning in, with a weekly report saying like these are coming up for renewal. Here's our recommended new rents. They're all like $75 to $100 a month higher. I'm getting anecdotally talking to clients. Like I have a client that just re-rented a 3-bedroom, 1.5 bathroom upper level suite in Mill Woods. They had it rented at $1,750. They just re-rented it at $1,925. Tenants didn't even bat an eyelash. Like that is a massive, massive increase
Yeah,
in
we
rent.
haven't seen that for years and years and years.
Yeah,
Like we forgot what the word rent increase even meant for a while there.
totally, totally. So like that's the cool. I mean, that's the double-edged sword of an elastic market, is that when it comes down, there's no real backstop to prevent it from coming down. But when it goes up, there's no limit to how fast it can increase, because we don't have rental raise restrictions in Alberta like there are in BC and Ontario. So, if the rents need to go up by $300 over the next 24 months or $400 over the next 24 months, they will. Nothing's going to stop that from happening.
Awesome. Well, we're almost out of time, James. This is like probably my most interactive episode. I'm gonna have to make some show notes because we went really fast. We covered a lot of topics.
Yeah, this was
So I
awesome.
want to thank you. But let's close it off. I want to hear a little bit about the Moguls Group. You have
Sure,
real
yeah.
estate agents in Vancouver and in Edmonton, and I understand you might even be opening up a branch in Kelowna. Is that
That's
correct?
right. Yeah. Yeah, I'm actually so yeah, we're Mogul Realty Group. What we do is we sell investment properties to investors on the residential side. Multifamily, ton of experience in our group from that, but like, small condos, suited houses, duplexes, development sites. If it's residential real estate and you want to purchase as an investment, that's what we do. A lot of pre-sales in Vancouver. And then we're going to be coming out to Kelowna to lead a pre-sale project over the next 12 months as well. So if you like talking investment and you want to have high level conversations with me, like Cory and I just had, because you're an investor, hit me up. I love talking about investing. It's all I do all day, every day.
Yeah, we might have to set up a networking event in Kelowna when you come, and
Oh, I'd love
because I
to.
kind of head up a local club here as well. So we might have to set something like that up as well.
Oh, let's do it. Yeah, I'd love to come out to Kelowna and meet a bunch of the local people.
Awesome. Thank you for your time, James. That was episode 10 of Multifamily Naked Truth. So hope you guys enjoyed the show, and we'll catch you on the next one.
Thanks, Cory.